Good morning, everyone. Today we'll start a new topic, which is the accounting cycles. So far, we covered two parts in our course. The first part is how to build up the database. What are the information we needed? How can we put it on data flow diagram, business flow diagram, and flow chart? And how can we create a small database on Microsoft Access? In the second part, we start talking about the risk that might happen to our database, like fraud, and how can we make control by following different frameworks like COBIT, like COSO internal control, COSO enterprise risk management, and the trust service framework. Today we'll talk about the new data that we need to collect it from different cycles. And the first cycle we will have it in chapter 12, the sales and collection cycles. In the coming three chapters, we will talk about the expenditure cycle, about the production cycle, and the HR cycle. So now let's go through the cycle and see what are the information we need to care about as auditors. First, as you can see here, the revenue cycle is linked to different cycles. As you can see on the bottom, you can see the expenditure cycle, the production cycle, then human resource cycle, and accounting cycle. And the revenue cycle is also related to different stakeholders. So several stakeholders are engaged with the company in the revenue cycle. One of them is the customers, the second one the carrier, and the third one is the bank. Now let us take a quick look on the flow chart, which shows the steps and the documents we needed in the collection cycle. First, we start by marketing department, where they send their sales representatives to meet with customers, try to get some orders from them, and once we receive the customer order, we send it to the second point, which is the credit manager, to check the credit history of the client. If the client has a good credit history, then we send the approval to the controller office to start making the bill and record it in the accounts receivable. If the credit manager doesn't approve the credit for the customer, then he has either to pay in cash or get a special permission. Once the controller is approving the invoice and recording in the accounts receivable, we get the quantity from the warehouse and ship it to the customer. And now let us look at the four phases that we have it in the revenue cycle. As you can see in this the figure, that first step is how to get the sales order. And as you can see here, there is lots of arrows going in and out. So I'm going to explain this in more details in the coming slides. But first step is how to get the sales order. Second, we do the shipping. Third, we do the billing. And finally, we make the collection. And you can see the four steps here in the four different circles. So let us look at the first one, which is the sales order entry. Under sales order entry, there are four steps. First, we take the order, then we approve the credit, then we check the inventory availability, and if the customer has any question, we try to answer it. What do we mean by sales order? The sales order is the document created during sales order entry. And this order usually has the item, the quantity, the prices, the terms of payment. This is a typical example of a sales order. Then, some customers nowadays, they don't send a physical sales order, but they have something we call it electronic data interchange, EDI, where the client and the supplier, they are connected to computer software, where the client can order the items and processed by the supplier automatically. And good example for that, like our accounts on Amazon. When we order, automatically it will be shipped from the Amazon. And then we say, from our side, as auditors, what are the risks or the threat that might happen in this process? And our job is to ensure that we have enough control to minimize the threat. First is the sales order might be incomplete or inaccurate. And what shall we do? We need to ensure that the data entry edit, there is some kind of control. And I hope you still remember what we discussed earlier in the previous chapters about the predictive control, about detective and corrective. And then we restrict the access to the master data to maintain accuracy. So not every employee has access to the master data. The second threat is the invalid orders, that some orders might go for invalid customers. And here we need to get the signature of the customer to ensure that this is authorized sales. The second one is we approve the customer credit. And we can do this by checking the accounts receivable aging trial balance. And here we can see that it's a report that lists the customer account balances by length of time. So you can see here, there is some customers where we put their names like Abel, Baker, other accounts. And then we can see what are the invoices that has been issued over the last 4 months to them and which one has been paid. So for example, you can see that there are 2 invoices that has been issued to Abel, 221 and 278, and they are still current. So it seems Abel doesn't have a long history of credit. The other one is Baker, who has 2 invoices, 178, which has been due for 2 months. The other one, it's still current, 245. So here we have to check the credit history of the customer before we approve the new order for him, and we can get this one from the aging trial balance. And then we say, what are the risks or the threats that might happen here? And we need to ensure there is enough control for that. The threat that could happen is that the accounts might be uncollectible. It means overdue for a long time. And the controls, we need to ensure they exist. First, we need to have limits for the credit of each customer. And if the sale is higher than the credit limit, then we have to get a special authorization. And then we have to make regular checks on the accounts receivable aging trial balance. The next one is checking the inventory, that we have enough quantity to fulfill the customer need. Here we might have some stock outs or excess inventory. And for both of them, we have some problems that we need to ensure that we have enough controls for them. How can we avoid the stock outs or the excess control? By using the EOQ, the economic order quantity, and perpetual inventory system. It means we have to make regular check on our inventory. We can do that by using radio frequency identification or barcode technology that can help us to check the inventory quickly. Also, we need to count the inventory on a regular basis and try to make reasonable, or let me say, accurate sales forecast. So here we have to ensure that these controls exist to avoid any stock out or excess. The last point is, if the customer has any question, we should be able to answer his question as fast as possible before we lose this customer. And here, this will help the company to retain the customer. So we call it customer retention. There is a department or a system called Customer Relationship Management System, which is a software that organizes information about customer in a manner that facilitates efficient and personalized service. And this means the customer will feel appreciated whenever he has any question or any problem with the order, and this will minimize the loss of the customer. So we can use CRM, which is Customer Relationship Management, use self-help website, make proper evaluation of customer service ratings. So this is in a brief, the meaning of doing good sales order. So I will stop here and I will come in another session to talk about the other steps.